Hello everyone, today is January 21st, 2025, and this is the Just Dario Daily. How is Scott Bessent going to deal with the Bank of Japan? The next Bank of Japan policy rate decision is approaching, and of course, much speculation surrounds it. I will not join the crowd because regardless of what happens next, it won't change Japan's fate in the medium to long term, as I have already discussed in these articles. 22nd of March 2024, why a historical JPY currency crisis is at the doorstep of Japan. 24th of April 2024, the JPY counterintuitive doom loop. 25th of June 2024, a peek into the future. USD JPY road to 300. 2nd of August 2024, a traveler guide to navigate the Bank of Japan mess. I will include the links of this article in the comments in case you want to go back and take a look at them. The BOJ decision will only have a short-term impact, and if you believe that the Trump administration is simply waiting idly for whatever comes, I have a bridge to sell you. The new US Treasury Secretary, Scott Bessent, stands in stark contrast to Janet Yellen, who only gained private sector experience through paid speeches to banks and hedge funds, an obvious payback for her support during her years at the Fed. Notably, Bessent was a key member of Soros' trading team that broke the Bank of England in 1992, triggering the British pound collapse and securing $1 billion in profit. He understands that economic theories and central bank maneuvers work only until they don't. You cannot perpetually distort a system that will inevitably break under specific conditions. Consequently, I'm certain he recognizes the risk to global financial stability posed by a JPY carry trade collapse. It's not a question of if, but when. You can be sure he's already had several conversations with BOJ and Japan finance minister officials, followed by coordination calls with the Fed and US Treasuries. So what should we expect? First and foremost, the JPY USD exchange rate carries more weight than the Japanese government bond interest rate. Why? Because the ripple effect of higher interest rates is much slower than a significant shift in exchange rates. Let me illustrate with a simple example. If you borrowed $100 million equivalent in JPY with a 10-year duration to invest in a USD-denominated asset, when rates move from 1% to 2%, the fair value of this loan decreases from 100 to 91.18. However, the borrower will still pay 1% interest for 10 years in JPY. Conversely, if the JPY strengthens from 156 to 140, the US dollar interest payment cost rises from 1 million to 1.1 million annually, and the loan repayment at maturity theoretically increases to 110 million. This immediately impacts the borrower's US-denominated liability fair value, which is why many hedge this risk with currency swaps that will trigger a 10 million present value transfer from the broker to the borrower. With trillions of US dollar equivalent in similar structures, brokers will simultaneously owe their clients billions in US dollar payments, inevitably triggering a major liquidity crisis in the global financial system. Conversely, if the JPY weakens 10% against the US dollar, borrowers who hedge the FX risk must post 10 million US dollar equivalent in JPY to their brokers, triggering selling pressures on their USD-denominated assets. Clearly, excessive JPY movement creates systemic liquidity problems either way, as demonstrated on August 5th, 2024, when the Bank of Japan aggressive currency market intervention to strengthen the JPY backfired. However, gradual FX rate changes allow counterparties more time to rebalance their position without fire-selling assets, mostly liquid ones like MBS or CLOs, that can mature at par, assuming no default events permanently impair their value. At this point, it should be evident that Bessent's goal will be to minimize JPY volatility as much as possible. The impact of higher rates will begin to surface when JPY carry trade need refinancing. At that point, if the borrower has invested in assets that have significantly lost value, They will have to either refinance at higher rates or book substantial losses. JPY carry trades against US Treasuries are relatively safe since US government default is highly unlikely. Such an event will be catastrophic. As long as these borrowers can hold until maturity without liquidity pressure, things are manageable. However, the situation differs when the invested assets carries significant credit risk. The JPY credit trade value at expiry is severely impaired, and the recovery rate won't offset principal losses. Mortgage-backed securities, commercial mortgage-backed securities, CLOs, private equity funds, and stocks all fall into this category. This explains why Bessent will do everything possible to prevent a credit event, especially since these assets often serve as collateral for JPY carry trade hedging derivatives. Will it succeed? It will certainly be challenging, given the economic market condition inherited from the Biden administration, and that I addressed in the article, how the Biden administration set up minefields all over the US economy to undermine the future government in case they lose election. Scott Bessent is clearly no fool, and he recognizes that a reckoning is inevitable for those heavily leveraged themselves through JPY carry trade, and now hold assets unlikely to recover their full investment value, particularly in the commercial real estate sector. Logically, he will aim to strengthen the capital position of particularly exposed banks, though this proves challenging since the same institutions have direct lending exposure to troubled sectors like commercial real estate. He has little choice but to force an overall system deleveraging at this point, reducing risk exposure before losses become unavoidable. Given that leverage and extreme speculation have driven asset price inflation in recent years, unwinding this position will inevitably pressure risk assets, especially stocks. Will Trump support this approach, considering he has traditionally used stock market performance to measure his administration's success? I believe he will if he can blame Biden for it. Therefore, we should prepare for a significant asset price correction during the first part of Trump administration, followed by market and economic recovery that he can claim credit for by the end of his term. Scott Bessent is ideally suited to orchestrate this transition while avoiding a liquidity crisis that could trigger another global financial crisis, a scenario that will likely prevent market and economy recovery by the end of Trump's second term. Given the strong US influence over Japan and its central bank, don't be surprised if we see this process begin this week.